I'm Alex Mozed, and welcome to Winner Take All, where we talk about the constant battle between large tech monopolies and traditional incumbents. To start us off today, our first topic is around Platt, the platform ETF that we worked with WisdomTree on. It's WisdomTree's ETF. It's basically the only ETF comprised exclusively of platform business stocks. There were about 80 or so stocks in this, and the ETF launched in May of 2019. So it's been about 15 months that it's been out. You can see this article here. New look, lower fee for a potent platform ETF. So it was just kind of rebalanced and repositioned. WisdomTree made it their primary growth fund, which is a pretty big deal. WisdomTree has, I think, over like 70 or $80 billion in assets across all of their different ETFs. And now Platt has become their primary growth ETF. So basically, there's two schools of investing: value and growth investing. Value investors are looking for, stocks that have value. Typically, not your tech companies, right, which have very high multiples. The value argument is much harder to justify with these tech companies because the multiples are so crazy. So the tech companies fit into the growth bucket. So basically, what WisdomTree has said is, hey, our growth fund is Platt, and the best and most powerful and highest growing tech stocks are platform stocks. So it's really interesting how, a very sophisticated, financial product instrument house like WisdomTree has embraced platform business model conceptually and made this their forefront growth fund. So I think it's a very wise decision. Not to mention, we helped them create the product about 15 months ago, or it launched about 15 months ago, as I mentioned. So I want to just kind of look at a few stats that we have here. If you go to WisdomTree's site, you can see this. This is just, informational page on WisdomTree's site. So there's the ETF, which is Platt, and the ETF tracks an index. It's a little bit of a technicality. If you want to dive into it, you can learn more about the index by clicking this link. Basically, what it's doing is saying, what are the top platform business stocks? And that's what Applico helps to identify. And I'll talk more about that in a second. And then we put all those stocks into a basket. And the ETF trades on the performance of the underlying, we have roughly 50 stocks in it currently, of the underlying 50 stocks and their respective weighting in this basket. So I'm going to jump into all this, right? Basically, the expense ratio was about 45 basis points. You'll see that here. Now it is 20. So that means that if you have $1 million, that let's say you put $1 million into the ETF, the fee you're paying is 0.2%. That's 20 basis points on that $1 million. It's kind of like the management fee. It's what they call the expense ratio. Basically, this is very low, right? If mutual funds are mostly around like 2% ish, maybe they're coming down to like 1.5. There's certainly, over 1% usually, or 1 to 2%, somewhere in that range. The expense ratio on this used to be 45 basis points. So now, because they are saying, hey, this is our primary growth fund, what they're saying is we're going to lower the expense ratio on this, and we're going to just, try and get more volume, more dollars invested into this, because guess what? The ETF has done pretty well. So if you keep going down and you look at the performance, so year to date, this is August 5th. So starting January 1st, 2020 through August 4th or 5th, 2020, it's up 31%. So if you put $10,000 in January 1st, 2020, you would have $13,138. That's what this is showing you. Now you can actually dig deeper. If you look since inception, since May of 2019, it's actually up 46%. It's crazy. 46%. And then you can compare it to the S&P 500. So May of 2019 till today, S&P 500, $10,000, you'd have a little under $12,000. Platt, you'd have $14,628. Plaid's really broken away. Basically, a lot of what we talk about on the show is that these platform stocks, the platform stocks, when you go into a dip, the platform stocks are these platform monopolies. They're going to dip less and they're going to bounce back faster. And that's actually exactly what we've seen here. If you look going into the dip, it dips less and then they bounce back faster. Conceptually, it makes sense. It's what a lot we've spoken about on the show, and now we're seeing it in the data. And a few other interesting things, that we're going to go over and looking at Plaid. But so I had some of our finance team pull together some stats that I thought would be interesting to list off. So this year, Plaid has outperformed the S&P 500 by about 28%. As I mentioned, I think Plaid's up around 31% this year, and the S&P 500 is up about 2.5% and change. So there's about a 28% differential between Plaid and the S&P 500. That's this year, 2020. Plaid has outperformed all of the top 8 largest and most popular growth ETFs year to date by a significant margin. I'm about to show you that. It has also outperformed similar kind of tech index ETFs by significant margins as well. You can see this. So this is 2020 year to date, right? So January 1st, 2020 through August 5th. This is you can see the S&P 500 down there. You can see QQQ, that's the NASDAQ 100. You can see some other kind of tech-oriented ETFs and mainstream ETFs, right? Like S&P 500, and how Plaid has done compared to these. And basically the takeaway is Plaid's beaten all of them. And why has Plaid beaten all of them? Because these are not only these winner-take-all, high-growth businesses, but they have these network effects. They have such defensible barriers compared to even other tech companies that would be linear but still high growth, right? We're seeing the power of these platform businesses really propel it into a league of its own. Now, the interesting thing, pre and post this rebalance, so leading up to basically last week, Plaid had about 80 companies in it that were all equal weighted. What happened in the past week when WisdomTree changed the name, made it the Primary Growth Fund, the number of companies in the ETF shrank from about 80 to 50. They adopted instead of purely equal weight, so if you have 80 companies, each one is worth 1% and change. It's all equally weighted in the basket. Now they adopted basically it's market weight and equal weight basically divided. And so you have some equal weighting and some market weight. So that means that you don't have FAMGA dominating, 80% of the index, but you still have market cap. And the power and scale of the platform business, the platform conglomerate, has some influence on how much weighting is given to that respective stock. Does that make sense? So it's a little bit of a diluted version of market cap weighting, right? Because otherwise, Apple, Google, Facebook, Amazon, Microsoft would just be so dominant. But there is some importance in scale, as we see with platform businesses, right? So what we talk a lot about on the show is the ability to have platform conglomerate status. So as you do have a larger market cap, it is safe to assume that you would not just have one platform business, but multiple platform businesses, and you truly kind of be in that platform conglomerate status. So that was some of the thinking around why wanting to bring in more of that, some more of that market cap weight into the balance of the basket. So you can see the change in the name before and now. You can see the expense ratio, right? 45 to 20. Revenue growth eligibility. So we put a requirement around having 7% revenue growth on these companies. So, there were some interesting platform stocks in that initial 80 basket, which had kind of been around for a long time, but they didn't really have much growth. They were platforms, multi-billion-dollar platforms, but kind of, they hadn't broken out into platform conglomerate status. They didn't have huge growth prospects. So WisdomTree put this growth qualifier on the stocks that can be in the basket. They also limited the exposure internationally. So entire international exposure is now limited to 12%. Before this, previously, you probably had about 12 to 15% from China, and you had maybe another 10% or so from Europe. So you had maybe 25, 30% international exposure. Now this is down to 12% in total, and China is limited to 5%. Pretty interesting dynamic. You can see other just lineup here of other indices and how Plaid has performed against them. But yeah, look, I mean, my thought on it is these platforms are just going to continue to dominate. And if there was any regulatory fear, the last live stream that we had looking at those judicial hearings, I mean, I think there is little to none risk about these companies being broken up in the next 5 to 10 years. I'd say 0% chance. I think there is a role for regulation, but it's not breaking them up. It's really to protect suppliers. We've spoken about this at infinitum on the show, protecting producers and suppliers as opposed to consumers. That's light years away from actually, breaking these companies up. So I don't think there's too much regulatory risk here. And you're just and because of COVID and the shift to digital and all these kinds, we're just going to see platforms continue to outperform. Another interesting stat our guys put together was the energy sector has been pretty volatile, hasn't been too well. Plaid does not have any energy sector stocks. There are no platforms in the energy sector. It's just extremely consolidated. It's there's so much big dollar contracts that are signed. It's very nuanced. There's a lot of logistics, very heavy stuff. It's highly regulated. It's just been it's very tough for a platform to penetrate energy. So there's actually zero energy exposure, and energy really hasn't done well at all, and is very volatile. So we're going to have more analysis on this. We're going to have one of WisdomTree's analysts come on the show this coming Monday, and we're going to talk to her more about the different changes that we made and some of the new companies that were added, because we've had new companies that have IPO'd in the past 12 months or so that met the criteria after IPOing, and so some of those were added. We're going to talk more about the basket, go into more detail with Kara, one of the WisdomTree analysts, on Monday. So that's going to be very exciting. The other thing to talk about here is platform revenue. So, what is Applico's role in this whole relationship with WisdomTree? It's not our fund, it's WisdomTree's fund. What we are doing is basically helping to provide data to WisdomTree to say, here are the companies with platform revenue. And if you think about this concept of platform revenue, there's no way you can pull that up in a Bloomberg terminal. It is a very nuanced thing to identify. So even platform conglomerates, even the strongest platform companies, Amazon, for example, has linear revenue and they have platform revenue, right? And that platform revenue is simply the revenue coming from a platform business. And so, when you think, how do you calculate platform revenue? What you need to do is identify, here is the platform business, and then how is that platform business monetized, right? And very often you will have linear revenue streams that are built on top of that platform business, right? So Amazon, obviously, they take their platform revenue from a product marketplace, is them taking a take rate on the product that a third-party seller sells. Right? It's usually, say, 10 to 15% roughly of a transaction fee from the third-party seller. That's why I say third-party sellers are Amazon's customers. That's actually who they're making money from. Linear revenue for Amazon would be the things that are coming from fulfilled by Amazon, right? Like when they charge a seller rental revenue, to store products in the warehouse, or fulfillment fees, the revenue that they're making from their white label products or their 1P sales where they're acting as a reseller, right? So it's hard because not all these companies break out the information as you would hope. So fortunately, we were able to go to some investor conferences and things like that to try and ask questions to these platform companies when we get the chance. That's kind of big wrench has been thrown into that because of COVID. But nonetheless, right, what you're trying to do is say, okay, how much of this is linear revenue? How much of this is platform revenue? And then we've identified 8 different types of platform businesses in the book. And so what we said is, okay, here are the different thresholds. And we worked with WisdomTree on this. What should be the appropriate threshold of platform revenue by platform type, right? Because what you're going to see is that, for example, a product marketplace like Amazon is going to have a much lower ratio of linear revenue to platform revenue because you have a lot of product marketplaces that are acting as a 1P seller and a 3P seller. You have that dynamic versus, say, development platforms, right? Versus content platforms that had advertising revenue. So advertising revenue for a content platform or a social media platform is a very different thing to look at than, take rate revenue from a product marketplace. So you really need to look at platform revenue on a platform type basis, right? And then against those platform types, so you have product marketplaces, service marketplaces, you have investment platforms, you have payment platforms. So payment platforms would be like we've got Amex, Visa, MasterCard in there, right? Investment platforms would be like MarketAxess, which is a bond trading platform, does phenomenally well. And then you have social networks, you have communication and collaboration platforms, you have content platforms and development, a couple different types of development platforms. So we look at that and then we provide that data to WisdomTree to say, hey, here's the platform revenue that they have. WisdomTree can make the determination if they fit the different thresholds or not. But really what it comes down to is how do you figure out what platform revenue is? And how do you calculate that? And that is really the determinant for what goes in the basket or not. Because we get questions all the time that says, well, why isn't Shopify in Plat? And I've spoken about that in the past, right? You have businesses that have platform businesses, right? Shopify. But the question is, do they have a material amount of platform revenue for them to be included in the basket, right? And so the answer for Shopify is they actually have a couple different platform businesses, a product marketplace with Shop, and then a development platform with an app marketplace. But that neither of those, and either individually or collectively, contribute a material amount of revenue to Shopify's business. That could change in the future, and that's what we track. And so they could be included in the index in the future, but right now, it's not a material amount of their business. If you want to look deeper into the full portfolio of what is in Plat, you can go to this WisdomTree page. And if you go to the bottom, you'll see, hey, here are the top 10 holdings. Amazon, Microsoft, Google, Facebook, Visa, MasterCard. Old school platforms, been around for decades. Platforms, though. Extremely strong network effects. Visa, MasterCard, and Amex. Amex is in here, but they're just not on this top holdings page. They take a take rate on the volume going through their payment platform network. Extremely strong business. PayPal, Alibaba, Tencent. Then you can go in here and you can see the full list of everything by weight. So Match Group, Booking. That's the other interesting thing about this. Plat has exposure to hospitality. Plat has Booking. We have Expedia. You'll see in here farther down. We have Yelp in here. So Plat has exposure to the restaurant industry. You've got travel and hospitality in here. It has a horizontal exposure, except for energy, across a variety of different industries. You've got Chegg in here in the education industry, right? They've done phenomenally well with the shift to remote education. You have CoStar, big in the real estate industry, right? You got Redfin in here. You got Zillow in here from real estate, right? So you have a nice cross section of a lot of different industries. But the point is, what are the strongest what are the strongest companies, namely tech companies, in every one of these verticals, in every one of these industries? And more often than not, you will find that the answer is it's the dominant platform company in that industry, right? That is the best form of tech company. That is the best form of growth company in that industry. And that's, pretty much how all of this came about. and Farfetch is in here. Yandex is in here. It's like Google and Russia. So you got Ping An Healthcare in here. That's a great story of a linear insurance company spinning off this healthcare marketplace platform. Amazing. We've spoken about that on the show. Really cool company. So that's some of the rebounds. You can go farther down. You can also view more of this broken out kind of by industry. If you really want to look at the full list, just click on this View All Holdings button and you'll be able to see everything. So let's talk about this example of Square. Why is Square not in Plaid? This is an interesting tweet. This guy was talking about Square's gross payment volume. So the Cash App for Square is a platform. It's a payment platform. This thing shows their gross payment volume. Yes, it's down, but it's still very strong. It's still a sizable amount of volume. And what this guy is tweeting about is basically here, Square can drive demand from their Cash App users. My highlight's not working too well. From their Cash App users to their sellers. So these are merchants via Boost and other methods, and they can help capitalize those small, medium-sized sellers to be prepared for the demand. Not many other companies can do that. What this guy, Kermit Capital, is discussing is that if you think about Square's business, what Square grew up as was not a platform. What Square grew up as was as a like easy to use, credit card terminal for small, medium-sized entrepreneur businesses. That's what Square grew up as. And by the way, that's still the majority of Square's revenue. That's why they're not in Plaid. What Square has tried to do, and Jack Dorsey has tried to do, and they've tried to do this in a few different ways over the years, is how do you get that red hot platform business, right? Which is then going to supercharge your other linear businesses. So instead of most companies they IPO on the platform and then they try to build other linear revenue streams on top of that. I got an example of that at the end of the show. Instead of going from platform to linear revenue streams, Square went IPO'd at linear and then has been trying to figure out, how do I get a platform? They bought Caviar for food delivery and then they sold that off recently. So they tried that out in food delivery. I mean, they made money on that deal, but it didn't become that red hot central platform kind of monopoly for them. The Cash App has been their best shot at this yet, and it's working. But when we look at their revenue, so transaction-based revenue here, this is their 10K, is almost $2.5 billion. Subscription and services-based revenue, that's where the fees from the Cash App come through. Like if you want to advance money into your bank account, then you can pay Square a fee, and then the money will show up instantly in your bank account, right? So they make some fees on that, but it's a derivative. It's kind of coming off these transactions and flow of money through the Cash App, which is their payment platform business, right? But there are other things in this subscription and services based revenue bucket, separate from just they call it like instant deposits or something in here. But even you take all that together, even if it was all of this $500-600 million revenue item, you can see that the Cash App still has more room to grow, right? Their primary revenue is still coming off of transaction-based revenue, which is the fees from their terminal product, right? And that's not a platform business. It could be a sticky business. It could be a great business. I'm not saying it's a bad business. All I'm saying is it a platform or not? And no, it's not. So they have some platform revenue, but it's not a material part of their platform revenue. I mean, of their overall revenue mix. Therefore, Square is not in Plaid, the platform index, the platform ETF, right? Makes sense? So that's a lot of what we look at when we put these numbers together and all this kind of stuff. Now let's shift to one of my favorite topics. I've spoken about this many times on the show. Microsoft and TikTok is now the latest iteration of it. But here's a video I did. This was July 22nd. This was a few weeks ago. Let's hear what we were talking about then. You got to spin it off. I think that's probably the only way that this thing is going to survive. It needs to be a separate entity from China ByteDance. And now this article just came out. It looks like they might be exploring a TikTok sale. This to me is an inevitable future state. TikTok will be spun off. Now, the question is, will TikTok's product and engineering and product and development resources, who are all in China, basically be transitioned out? Now, this doesn't need to happen right away. I don't expect you to fire 1,000 people or whatever the number is in China and say, okay, great, we sold TikTok. Now we're going to fire all of you. You're gone. No, I give you like maybe 2 years. And I think that's generous. 2 years to rapidly transition 80+% or maybe 100%. I don't know. Maybe 3 years for 100%. You could have milestones, right? Like after a year, this much, 2 years, this much, 3 years, 100%. 3 years, 100%. All product and engineering needs to be done outside of China. You get the idea. We're saying TikTok needs to be spun off. And now we have Microsoft. So Microsoft is saying here they could buy TikTok for as much as $30 billion. And I don't know. Basically they give you a $20 billion range. Not very informative. But this was the key term here. Microsoft has already agreed to transfer all of TikTok's code from China to the US within 1 year if the deal goes through, which they're saying it could be 15 million lines of code. And, oh man, I mean, you just think about how there's a lot of execution risk with this deal. Let me put it that way. Apparently, by the way, this is only for the TikTok US business. So I have no idea what that means. What happens to TikTok in Europe, right? And who knows? Even just the technicality of pulling this off. Okay, you got to assume that no one messes with the source code and they give you good source code. Let's assume that goes over, right? And then what you now need to do is, like, are there any like back doors in the source code, right? Like the whole thing was that you were trying to separate this from China for all these privacy and security concerns. 15 million lines of code. I mean, how would you actually even detect that or scrub through it? Assuming you got it and assuming, hopefully, and say, okay, there's nothing malicious in here. So you got to make sure that. And then the second thing is, now what do you do with all these engineers in China? Are you still going to let them work on the product? How are they going to work if now you're kind of locking down the code in the US? And, oh, by the way, that, if those engineers have access to the data and the code, then the Chinese government has access to the data and the code. So, now you've got to do what I was talking about in that initial video. You got to figure out this personnel transfer. They haven't even started talking about that. What do you do with all these Chinese engineers? And how does Microsoft, create a separate team in the United States? Oh my Lord. Honestly, like, it sounds good on the surface. We're going to buy this business and yada, yada, yada. I really wouldn't want to buy it. It is just tough. Honestly, what I'd probably want to try and do is like buy TikTok and buy Triller. Triller is a somewhat similar version to TikTok. Doesn't have the scale. I'd say TikTok engineering wise, it's loading videos faster. It's a much more seamless experience than Triller. But I just feel like if you're going to spend $10 to $30 billion on something, apparently Triller is trying to raise money on that $1 billion valuation. You want a US based entity where if now you've gotten all the data, you got all the data from TikTok and you got all the users from TikTok, and now if you're just talking about what technology product do they use, part of me says I would much prefer to take the data and put that into Triller, which has a team in the United States, which I don't have any of these concerns about what's going on. Is there any funny business with the source code? And, how am I going to separate culture and people and code? And, how do you cut that cord? Like that to me, I would probably prefer to do that than now take the code from China to the US, have to transition all these engineers. What am I going to do? Cut off all the engineers' access? It is going to be such a gargantuan effort. And things are going to go wrong. And if one party wants to screw the other party it's going to be very easy to do that. Let's not even say that it's TikTok. Maybe ByteDance wants to do the deal. You could there's so much room for bad actors, not management, but just bad actors up and down the chain of just people that have dependencies that can do one little thing here, which just has huge ripple effects. I don't know. This could end badly. I don't feel too good about this. I mean, I like it conceptually, but when I think about actually executing it and pulling it off, it just seems ripe for issues. So we'll see what ends up happening with it, but I'd probably look to buy both. If I'm Microsoft, I'm putting $15-20 billion into this. I'd put $15-20 billion into TikTok, and then I'd go buy Triller, and I'd try and actually use Triller as my main hub and merge the TikTok stuff into Triller, and use that product and engineering team as my base. Otherwise, trying to do this all on TikTok and port it over, I'm not even an engineer, and I get the heebie-jeebies thinking about it. So we'll see if it actually ends up happening or not. Next topic is, so this just came out. Livongo and Teladoc are merging. Teladoc is the virtual remote telemedicine platform. They've been on fire. They've tripled in their stock price in the past few months. I think it was around $70 a share. Now it's in the 200s, doing phenomenally well. And now Livongo and them are merging. And this, I guess, just came together in the past few months. Livongo specializes in remote coaching for diabetes, among other chronic conditions. When I think about a Livongo, I believe they are doing this all with their own staff. I don't think there's a platform dynamic with Livongo. So to me, kind of what I was talking about before, where you have many platform businesses that, the platform IPOs, and then you try to put linear revenue streams on top of that. That's actually what this is to me. It's a digital linear business, Livongo. They're providing coaching. And I think my understanding is they're providing a lot of tools and services to at-risk patients. And so they'll work with an insurance company. The insurance company will say, hey, I want you to give your solution to this at-risk population. And if you can bring down or improve their health, it's worth whatever money I'm paying to Livongo, or they can have cost sharing revenue, kind of cost sharing plans to generate revenue. It's kind of like a linear, digitally enabled, this remote coach for these at-risk patients with these different chronic conditions. And so now, where Teladoc has the platform model, Livongo has that linear model. There might be parts of it that are platform, but what you're doing is kind of taking the platform and the linear, you're putting them together. Teladoc is going to be able to better monetize and now have a bundled service offering where they have, the platform marketplace for remote telemedicine and these kinds of things. And then they have a much more kind of premium, this linear offering from Livongo, which they can now deliver much more kind of targeted results for these patients and these at-risk patients with chronic conditions. I think this would be really interesting. I like it, actually. Again, you're kind of taking that platform and the linear, you're putting it together. It's going to allow Teladoc, or the merged entity, to have a much stickier solution with, with the healthcare companies, with the providers, and all the players really involved in that healthcare supply chain. So I think that'll be pretty interesting for them. I'll talk to you on Monday with Kara, and we'll go more into some earnings season, into Plaid, and some of these other areas. Thanks for joining us today on Winner Take All. I'll talk to you next week.